Hi, everybody. This is Richard Thornton, and we're going to talk today about how you can create financial security by investing in mortgage notes and gain higher overall yields than the stock market in a more secure fashion that are consistent, passive, and, if you use a self-directed IRA, tax-free. Now, before we get started, I have to confess something to you, and that is that I love this business. As far as I'm concerned, it's a win-win. It's a win for the homeowner who gets to buy a home and might not otherwise be able to participate in home ownership. And it's a win for you, the investor, who gets a higher overall return that's more secure than the stock market. So let's first talk about what is a note. A note basically is a promise to pay or evidence that payment has been made. So it can be a dollar bill, it can be a check, it can be maybe a title to your car, or it could be a home mortgage. And in this case, we're talking about home mortgage notes. And you're becoming the bank. Now, a lot of people don't even know that you can invest in home mortgages. They think that it's just something that you get on your house and you get it from a bank. And what they don't realize is that banks buy mortgages from other banks and mortgage lenders every day. But they do it in bulk, and they do it at much less yields and lower margins than we're going to discuss here. So a mortgage note has to have the terms of agreement, the loan amount, the interest rate, the term, a payment, and basically be signed and dated by Mr. or Ms. Homebuyer. To help us understand all of this, we're going to follow a family named the Midwests. We focus on homes that sell for $80,000 or less throughout the Midwest, Southeast, and Southwest. A lot of people don't know this, especially if you live in metropolitan areas like San Francisco, Seattle, New York, or other places. But throughout the Midwest, you can buy a very nice working class house for less than $100,000. So let's meet the Midwests. Here's Bob Midwest and his wife, Mary Midwest. And Bob is a school teacher at the local high school, and Mary is a staff accountant. And they decide that they'd like to buy a house. Together, their combined income is about $70,000, and they've got a good credit rating. So the first house they look at is in Boonville, Indiana. And it's a nice little 2-bedroom, 1-bath house that's on the market for $63,000. They decide that they don't like the floor plan, so they'd like to look at another one. They find another one in Middletown, Indiana. It's 3 bedrooms, 2 baths for $68,000, but it has a huge yard, and they really don't want to take care of that. They look at many other houses, and they finally end up finding one in Kokomo, Indiana, that they can call Home Sweet Home for $42,000. Bob and Mary are very happy. They're buying it from a fellow named John, who has lived in the house for many years and has a lot of equity. So once they sign the contract to buy the house, they go off to the bank to get financing. But unfortunately, the first bank they talk to says no. The next bank they talk to says, I'm sorry. And Bob and Mary just aren't very happy, because this means they're not going to be able to buy their house. And they really don't know what to do. And they're wondering why they can't get financing. And the reason has nothing to do with them, but it has everything to do with something called Dodd-Frank limitations. Before the recession, there were so many abuses in the lending market, Congress felt that it needed to tighten down the regulations. And they were sponsored by some congressmen named Dodd and Frank. And part of that legislation requires that lenders making loans that range from $20,000 to $60,000 can't charge any more than 5% of the mortgage amount. So if you've got a $40,000 mortgage, which is about what we're talking about here, that would be $2,000. And a lot of the lenders say, sorry, we're not going to do that. Because by the time they pay their loan officer $800 and they pay for an appraiser and they pay all their other fees, they can't make any money. They'd much rather focus on the larger end of the market. So it has really nothing to do with Bob and Mary. But there's a lot of Bob and Marys out there who can't get financing. So they don't know what to do. So they go back to John, the seller, and he saves the day with a seller carryback loan secured by a mortgage note. He says, I'll be the bank. I'll, in essence, lend you the money if you give me a down payment. Now, the numbers I'm going to use here are a little bit funky, meaning that they're not nice and rounded off. And that's because this is an actual case study. We actually bought this note, and so it's real world. And as often the case, real world numbers aren't exactly all zeros and rounded off nicely. So Bob makes them a loan of $38,012 at an interest rate of 8% with a term of 20 years and a monthly payment of $318. They're not wild about an 8% loan, but they certainly can handle a monthly payment of $318. So they agree to it, and they are very excited about moving into their new house. So they have bought a $42,000 house. John, the seller, has taken back a mortgage for $38,018, and John and Mary put down $3,982. So time goes on, and John is enjoying getting his monthly payments of $318. But as they say, life happens, and he decides that he'd rather have the money rather than getting the payments. So about 3 years later, he goes to an exchange, or he calls up somebody like me and says, hey, would you buy my mortgage? And I say, certainly, I'd be glad to look at it, but you made it at an 8% rate, and I can't sell that to an investor. But I could buy it at a discount if you're willing to consider that, which would mean you'd get a little bit less for it than its face value, and I would get a higher yield. So we talk about it, and we come to an agreement that I'll buy it. And he says, great, I'm going to send my grandkids to college, and I think I'd like to buy a new car. And oh, if I have enough money, I will take a little vacation to Hawaii. So in our case study here, we have the value of $42,000, and the buyer has equity of $3,982, and they made 3 years worth of payments, which is 36 months, and it's going to take us a month to close, so they will have made a total of 37 payments. And we negotiate a sales price of $31,125, and there are 203 payments remaining on their 20-year loan. Now, what we're buying is a first trust deed. We're buying a lien on the house. We're not buying seconds. We never buy second trusts or anything like that. We only buy seasoned loans that have good payment histories. So we buy it, and we pay for it with my IRA. That means that I get the income tax-free, and I don't have to pay any taxes on it until I actually take the money out of my IRA at the end of the day. Or if I wanted to have a Roth IRA, I could actually pay taxes on it now, but then I wouldn't pay any taxes on it when I took it out later. And that depends on your choice. So what am I getting? I'm getting for my $31,125 what I call mailbox money, which is money sent directly to me from John and Mary of $318 a month. And I'm a pretty happy camper. And I can turn around, since I work in this field, and I can sell the note to somebody else, an investor, at maybe an 8% yield or a 9% yield. What I'm getting is 203 payments for a total of $64,554, which is an effective yield of 10%. And I'll keep just a little bit of that, maybe a couple $1,000s, and turn around it and sell it to somebody else for a little bit less. So I could sell the entire note, which would give the buyer an investment of $318 a month, as we've discussed. But a lot of people say, well, I really don't want to make an investment that's almost 20 years in duration. Can I get a shorter term? To which I say, sure. How about if I sell you the first 120 months or 10 years? I'll sell it to you at the same rate, and I'll keep the back end. So I don't get paid anything until you get paid for 10 years. You can pay me $24,063. For that, you'll get $38,160, which is a 10% annual interest rate. I'll keep the back end, and I'll be able to make you a smaller investment, which is what you wanted, which will have a shorter term. So let's step back a little bit and consider why we should buy notes in general. Now, notes tend to be a better investment than the stock market. As you know, the stock market is volatile, and notes are consistent. Now, I want you to hang with me here because the graph I'm going to show you in just a second is very technical, and it shows the volatility of the stock market over the last 10 years. So here we go. Yes, folks, that's what the stock market has done over the last 10 years. It's gone up and down and all around and sideways. Sometimes it's up, sometimes it's down. And we all remember that on September 29th and 28, it crashed and we started the recession. In 2 days' time, the market lost $91 billion. It went out of the stock market and was gone, as opposed to investing in notes, which provide consistent returns. Now, what everybody asks, and which is the elephant in the room, is what if the borrower defaults? So we're going to talk about why we think notes are more secure than the stock market. If the borrower defaults, you can foreclose on the house and rent it out. When we buy a note, we always look at the market and figure out what the market rents are. In this case, the borrower is paying $318 a month. Yet market rents are about $600. So don't you think it's a very high likelihood that we could rent the house for maybe even $500 or $400 a month, even in a slow market, and get paid more than we were on the mortgage? Or we can sell it. The house is worth $42,000 right now. We invested $31,000, and a number of years have gone by. So let's say the mortgage value is now $28,000. Do you think that we could take that $42,000 house, even in a slow market, mark it down to, say, $30,000 and get our full $28,000 back? We probably could. One other exit that we have is that there are a number of investors that like to buy defaulted notes because they think there's future upside in them. And so there's a good likelihood that they would buy your note for its full value. Now, none of this is guaranteed, but it's more secure than you're going to get from the stock market, which has no security at all. So let's talk about the market in general. Right now, the Mortgage Bankers Association estimates that the 90 days or later payment rate is only 3.4%, meaning that only 3.44% of the payers are 90 days late or more. In the worst years of the recession, the default rate on first trusts, which is what we're talking about, was only 10.51%. And you can say, well, gee, how would that cause a recession? Well, that 10.51% consisted of loans that were made according to prudent lending criteria. It was the subprime loans that never should have been made in the first place, that 43.75% of those went bad, and that's what got us into the recession. You have to remember that the borrower was always going to want to protect his equity. Just as if you're a homeowner and you've put $10,000 or $15,000 in your house, you'd rather not lose that, right? And you'd rather do everything that you can to protect your investment in that house, which in turn protects your investment in their house. Plus, as we talked about, you have the collateral value of the home. In this case, we paid $42,000 for the house, and we only paid $31,000 for our mortgage. There's value there. And if you buy a partial, the note seller is behind you, meaning that he's going to be very interested in what goes on with that mortgage, keeping it current and making sure that you get paid so that he gets paid later on. So let's summarize. Mortgage notes can provide stable income with great yields with less risk than stocks or other vehicles. They can also help you know where your next paycheck is coming from. If you're commission-based and you only get paid on your current sales, it can help you know where your next paycheck, or at least part of your next paycheck, is coming from. It also can help in market downturns, the next recession, or whatever might go wrong. And they can help you build your retirement tax-free. So that's our presentation for today. I'm sure you might have some questions. And if you do, I'd urge you to call me, Richard Thornton, at 510-918-9001, or message me on Facebook or LinkedIn, or even better yet, schedule some time with me at calendly.com/American Note Capital. And we can talk about notes and reaching your financial goals together. Now, keep in mind, this is not going to be a sales pitch. I'm not going to sell you on notes any more than I have here today. I'm here to help you make prudent decisions for your financial security. So remember to call me at 510-918-9001, or better yet, go to www.calendly.com/American Note Capital and set a time on the calendar for us to speak. I look forward to hearing from you soon.